Hello and welcome to Morning Markets. I'm Roger Peterson. Thank you very much for joining us. Here are some of the stories we're tracking for you in the BNN Bloomberg newsroom. Ontario's projected deficit is almost double what was originally expected, with the government now suggesting it will be more than $13.5 billion in the current fiscal year. The updated figure is nearly $8 billion more than what was laid out in last year's budget. The province is citing trade tensions and geopolitical forces as the driving factors behind the increase. China has started 2 investigations into U.S. trade practices. Beijing says the probes are to safeguard the interests of Chinese industries and are in response to investigations announced by U.S. President Trump earlier this month. China has expressed a firm opposition to America's investigations. The move comes ahead of Trump's visit to Beijing in May. Bell Canada is selling its land mobile radio network services business to Motorola in a deal worth $675 million. The business provides two-way communication services such as walkie-talkies and push-to-talk systems. Motorola's CEO says the acquisition will help protect long-term resiliency. The deal is expected to close in the fourth quarter. BCE, of course, the parent company of BNN Bloomberg through its Bell Media division. Taking a look at the markets, another down week by the looks of it, but now the TSX has turned around. At one point it was off, it was down, it was up, then it was off again. Now it's seeing a little bit of a rally, up 0.37%. Energy and materials leading the way, tech taking a hit right now. Again, south of the border, this is the kind of day, kind of week it's been. That's a more realistic look. I think the S&P 500 up by about 0.8, the Dow by about the same, and the Nasdaq's off by nearly 1.2. 2 large container ships from China have been blocked from crossing the Strait of Hormuz, adding to investor jitters over when the war in Iran will end. Meanwhile, oil continues to swing. There are some predictions crude could surge to $200 US a barrel if the conflict goes beyond June. My next guest says the market is pricing the conflict through oil rather than global demand. Here to break it all down is Mike Dixon, head of research and quantitative strategies at Horizon. Mike, thanks very much for joining us.
Thanks for having me.
Okay, so you say the conflict is being priced through oil, not global demand shock. What do you mean by that?
Yeah, with the headline that you just mentioned, we saw this with commentary from a lot of central banks last week as well. At this point, we are seeing their reaction exclusively through this inflation shock and inflation fears. And you've seen a significant repricing in interest rates as a result. But when you look at the interest rate market, one of the things you don't see is real interest rates kind of stripping out that inflation component. You don't see those collapsing, which would be exactly what you would see if there was kind of a global demand shock being feared at this point. And that's exactly why, I say this is certainly very oil-centric. And a couple other data points to that. You look at measures of oil volatility. The OBX is one I always like to reference. It's kind of the lesser-known cousin of the VIX index for the oil market. This is basically at all-time highs, absent the COVID shock that sent oil futures negative back in 2020. And at this point, yes, it's still exclusively about this oil shock and how much inflation this is going to cause. And it's just purely, a variable here is the duration of this conflict and how long this is going to last.
Now, what about your thoughts on the 200 a barrel possibility if it goes into June? I mean, we saw it spike at 120 earlier, and then it kind of has calmed down and has hovered in the 90s for much of this conflict.
Yeah, I saw that headline as well, and that's obviously an extreme number. One of the things I think that's true about that number is, frankly, I don't think you're going to get there with just a supply shock that we're dealing with here. I think if you go back to perhaps like the 2008 time period, where you saw, of course, the demand side of things, sending oil, I believe, to around the $150 level at that period of time. I think you're going to have to see a combined kind of demand and supply shock to get anywhere close to those numbers. At this point, we're nowhere near that, of course. So like I mentioned with interest rates, you're not seeing interest rates price that in any capacity at this point. And that's certainly quite a speculative guess at best. To get up to those values commodities, but that's going to have to come with a significant hit to global growth from the demand side if you're going to start creeping up to those levels. And that'll be, again, a function of time and how long that we do not have ships passing through this strait. And at this point, I think it's a little premature to say that that's in the cards anytime soon.
All right. And who's feeling? I mean, we saw the Nasdaq today talking about correction territory, but other emerging markets are down 12%. What's driving that? Is it strictly the oil, or are there other factors in that?
I think there's a few other factors in that. I mean, I think that, look at emerging markets is kind of an interesting place to look. Prior to this conflict, emerging markets were having their best year-to-date start versus, broad global stocks and U.S. markets that they have in the last 30 years. And if you go back to 2025, emerging markets also had a very, very strong run, up close to 40%. So you're coming off with emerging markets having a great start and a great, longer 12 to 15 month run. So there's, some profit taking certainly in play there. But then as it relates to oil specifically, emerging markets in those Asia regions specifically get a lot of their oil, very large majority from the Persian Gulf region, and as a result have been much more in the crosshairs, of this conflict. And then, additionally, it's just much more of a cyclical trade overall, a little bit higher risk. And so you've got a little bit of a higher risk trade to begin with, greater sensitivity to oil from that region, and the fact that they have been very, very strong performers leading up to this point has all had those areas of the market feeling, I think, a little bit of the more of the brunt of this than you have, here, on the U.S. side of things. But look, for folks that might have a view on the duration of this conflict and diplomacy being sooner rather than later, pullbacks like this create opportunities. And, we are looking at emerging markets down about 15% since the conflict began. So that is a data point to be aware of.
All right, one other. I want to wrap it up all in a little bow after this. But metals and minings, they're down about 12% as well after a great 2025. Is this a reset, or is this like copper I saw today is closing in on a one-year low?
Yeah, again, I think if you're talking about emerging markets or metals and mining, I would put the metals and mining more of, more in this kind of like riskier tactical opportunities. Again, really strong performer in 2025. Definitely has seen a pretty solid pullback similar to emerging markets this year, but could provide an inflation hedge and an interesting buying opportunity for riskier, kind of a riskier tactical opportunity. But there's also some tactical opportunities, I think, that have a little bit more cushion than either emerging markets or metals and mining. And I think those are some interesting opportunities to talk about as well. Is
that you're talking about software and services?
Yes, specifically, I would point to the software and services as well as the utility sector overall. Hitting on utilities first, we've had interest rates go up a lot over the last couple of weeks. And utilities tend to trade pretty well with interest rates. So if we get interest rates coming down a little bit and you get a lot of their more traditional defensive properties kind of kicking in, they could be a solid defensive sector if this conflict goes on for longer. But additionally, utilities have had a really strong run just on the more secular AI infrastructure demand side of things through grid build out and power demand overall. And so you get a little bit of an offensive and defensive play on that utility sector. And then, look, as you mentioned with software and services, you saw those sell off significantly prior to this Iran conflict on the threats that AI is going to make a lot of these names completely irrelevant. And they're sitting at basically 10-year lows as it relates to valuations. And I think you've had a lot of good quality names there that are just kind of getting thrown out with the overall sector threat as a whole. And there's a lot of really good names, I think, that are playing at really cheap valuations that could be some really interesting opportunities, just given this volatility that was, independent of the Iran conflict, that I think is a good place to look.
All right, we'll wrap it up there, Mike. But thanks as always for joining us.
Thank you.
Mike Dixon is head of research and quantitative strategies at Horizon. Up next, more about how Ontario's 2026 budget is forecasted to exceed expectations. Stay with us. Ontario's 2026 budget is forecast to be nearly double initial expectations. For more perspective, we were joined earlier by Peter Bethlenfalvy, Ontario's finance minister.
Well, I think there's three things. We're definitely in a softer economy. I mean, that's a global trade turmoil and now global conflict. So clearly, right around the world, softer economy. The second component would be our population in Ontario has grown by 2 million people in the last 8 years. That's a good thing, but of course the majority of expenditures fall on the province to fund the supports for those people, healthcare, education, social services. So that's impacting our investments and our costs. And thirdly, we've chosen to cut taxes for people and for businesses, putting more money back in their pockets, just like we did yesterday, announcing the small business tax cut. 375,000 businesses that will benefit from a 30% tax cut. They'll create more jobs. They'll grow the economy. So those are some of the factors. It's the world we're living in and some of the choices we're making here in Ontario to protect people and protect businesses.
Difficult choices, I'm sure, to make. I want to talk about that tax cut for small businesses in just a moment, but are you comfortable with the size of this deficit? I take your point that decisions needed to be made because of the state the economy's in.
No, I would like to balance sooner. I think deficits are temporary and should be temporary. But, you know, relative to other provinces and other jurisdictions around the world, frankly, we have some of the lowest deficits relative to our economy. And don't listen to me, listen to the credit rating agencies who have upgraded our credit rating over the last couple of years. And also the relative size. I mean, BC had a $13 billion deficit as well. We're 3 times bigger than them, and we have the same size deficit. So I think we're being prudent fiscal managers, but at the same time, leaning into building infrastructure, leaning in to make sure investments are made for the people of Ontario, and at the same time, supporting businesses and the economy with tax cuts.
Okay, so let's talk about the small business tax cut first of all. It's estimated to be about a $5,000 tax break for small businesses. Is this going to be enough, though, given the state that many small businesses find themselves in? Especially last year, there was that $9 billion in temporary tax deferral relief that was kind of had low uptake. So what did you learn from that last year? And is this actually going to be enough for small businesses this time?
You know, if we could just look back to the supports that we gave last year, so 2 billion companies took us up on the tax deferral, so that helped with liquidity. That's a meaningful amount of money. Another 2 billion through WSIB rebates. That's a meaningful amount of money that went into the pockets of the businesses and small businesses right across Ontario. And I would say, yes, this is a significant tax cut for small businesses. Supported by the Canadian Federation of Independent Businesses and many other stakeholders across the province. This will really spur economic activity. And I would add, we had another tax cut yesterday that we announced, the HST rebate, some 13% on new homes. This will spur housing activity. It's a huge affordability measure for families, but it's also going to spur construction jobs, 21,000, and a growth in our economy, according to economists, of $2.7 billion. So we've got a plan that really is fiscally responsible, invests in infrastructure, invests in our social infrastructure, but also boosts the economy.
There's also more than $100 billion going into healthcare. So what improvements can people actually expect to see on the ground in hospitals and in other healthcare settings?
A couple areas. For instance, we're really leaning into home care. I haven't met anyone that doesn't want to age at home. So transforming our system to be able to deliver some of that care, be it a nurse, a PSW, a doctor, to the home. So we're continuing to make record investments to allow that transition to happen. Investing in primary care, we announced yesterday $3.4 billion to put more money getting family doctors to every person who wants a family doctor in Ontario. We lead the country in that regard, but there's more to do. So these are the types of investments that we're making to ensure that people are taken care of, not only in the right place, but it's also good economic policy, because if people are healthier, that's good for their social quality of their lives, but also their economic opportunities.
For sure. But are there any investments going to like hospitals and particularly ER rooms?
Oh, again, record investments in hospitals. I mean, our hospital investment is up some 55% since 2018. You haven't seen an increase like that ever, I think, in Ontario. An additional $1.1 billion announced yesterday. But my message to hospitals as well, and they've been doing a great job to innovate, think outside the box, deliver, use technology to cut the paperwork, cut administration and red tape, deliver more for our frontline doctors, our nurses, our personal support workers, for the benefit of patients. There's a lot of opportunity there. They've been great partners in that, but there's more to do.
Okay, so we'll move on. Removing the HST on new homes will cost the province $1.4 billion. That was announced yesterday, expected to generate about 8,000 new housing starts. Is that level of spending, $1.4 billion, justified, given such a relatively small number of new builds will come out of that?
Well, I'm sure you've talked to many of the stakeholders. They said they're calling this a game changer. Experts right across the spectrum, whether people in the industry, construction workers, policy think tanks, they're saying this is a game changer. As I mentioned, a big boost to the economy, a big boost to construction jobs. I was with the Premier on Wednesday and met a lot of the construction workers. I've never seen them smile so much. Our construction industry has been hit with the slowdown in housing construction. So this is a big shot of stimulus into the housing sector, all at the same time providing an affordability measure for many families who are dreaming of buying a new home, be it a townhouse, a condo, or a detached home. So this is really, I think, what the market wanted, and we heard, we listened, and we're delivering.
The budget also sets up a $4 billion Protect Ontario account investment fund. It's managed privately, though. So how will the government ensure those investments align with taxpayers' priorities?
Well, first off, the principle that we wanted to signal yesterday with the Protect Ontario Investment Fund is that we want to bring in not just the government's money, but other private sector money to invest in companies that are creating jobs here in Ontario so they don't leave Ontario. We've got great companies in AI, defense manufacturing, energy in the nuclear space, critical minerals, life sciences, advanced manufacturing. So we want those companies to grow, find new markets to export, to diversify trade. And so that's the purpose of that. We'll continue to work on details over the months to come. We're setting it up much like we did the Building Ontario Fund, which is our infrastructure bank, which is the same model, arm's length with a board and a governance model to bring in other investors to get long-term infrastructure done. That's done deals in the long-term care sector. It's done deals in student housing, affordable housing, and also nuclear energy through the small modular reactors. So this is the type of out-of-the-box thinking that we need at this moment in time, given the evolution of our economy and the global trade system. I think these are the smart type of investments which will propel Ontario's economy and continue to create really good-paying jobs for the workers in Ontario.
Just before we wrap up, you've mentioned a number of different areas where you could be investing some of those funds. Is there any priorities in terms of where those investments will go?
Well, those are the priorities. I would just maybe go another level for nuclear energy, for example. That's going to create a lot of opportunity in our small modular reactors, new nuclear build, the Pickering refurbishment in my riding for nuclear stations. I mean, that's going to create, just in Pickering, 30,000 new jobs, a tremendous amount of economic activity. And the technology and the supply chain around nuclear, I mean, the world is envious of what Ontario has. And so that's an advantage. I would just add the critical minerals, another area where those minerals are all here in the ground in Ontario. You have to go to far-flung places to get those minerals, like China or parts of Africa. We have them right here in Ontario. We have a real advantage. We've got incredible talent, mining expertise. These are good-paying jobs, so we're going to lean into areas such as critical minerals as well.
Lindsay was speaking with Peter Bethlenfalvy, the Ontario Finance Minister. Coming up, we'll have a look at why big tech and the NASDAQ 100 is facing a correction with Bloomberg's Ryan Vlastelica. See what's dragging the NASDAQ 100 into a correction. To give us a strong analysis on why this is happening, we're joined by Bloomberg's Ryan Vlastelica. Ryan, thanks very much for joining us. It's been a rough ride. What are the key factors here?
Good. Well, Throughout this year, we've seen sort of a big rotation out of large cap tech companies. There's been growing scrutiny and criticism and concern about how much these major companies, notably Microsoft, Meta, Alphabet, Amazon, how much these companies are spending on AI-related initiatives, and growing concern about when all of that spending is going to pay off in the form of more pronounced revenue growth, greater efficiencies, so on and so forth. I think we also have just seen a real change in the macro backdrop, most notably because of the war, with people just looking to sell stocks kind of en masse or moving to more defensive parts of the market and away from the more high growth or risk on parts of the market like tech.
And I'm just looking at some of those names. We have up what the day losses are, but NVIDIA's down for the last 6 months by about 5%, Microsoft by 30%, Meta by about the same. What kind of an impact does it have on those companies?
Well, a lot of people remain very positive about the long-term prospects of these companies, and certainly their valuations have gotten down to multi-year lows. So a lot of people would say they are very attractive following all this weakness. But we do have these big picture concerns. The amount of money they're spending is having an impact on their free cash flow and their cash piles. There's also sort of related concerns about AI overall, and how much is this going to disrupt legacy businesses? Software in particular has seen a lot of weakness on this concern. Are people going to start going to AI first companies like Anthropic or OpenAI and away from legacy companies like Microsoft or Adobe and so on and so forth? So there's some real growth concerns about them. But at the same time, like I said, a lot of people remain very optimistic about the long-term potential here.
And within the NASDAQ, is anybody winning right now over, say, the last 6 months or since October?
There's been a few pockets there, and some of them are related to different parts of the AI space. So I know this gets complicated, but if you look at some of the memory and storage companies like Micron or SanDisk, there's some optical related companies, which is a even more technical part of the AI infrastructure stock. So all these kinds of companies that are involved in the building of data centers, which is where AI workloads are processed. A lot of these kinds of companies have seen pretty strong growth, and they've seen really strong momentum in their stock prices. Of course, they are usually smaller names, so it hasn't been enough to kind of overshadow the bigger picture risk pullback.
Now, of course, obviously, the war is having a major impact. Will we see a bounce back or recovery if and when this war ends, or is this something that is looking like it may continue?
Well, a lot of tech companies don't have the kind of exposure to commodity price volatility that other parts of the economy do. So it could be possible that if we do see some kind of end to the conflict, obviously it would depend on the details here. If there is a more risk-on sentiment, it is likely that you'll see tech participating in that to the upside. Obviously it really depends on the details. It really depends on how much sort of disruption related to the energy space, how long that continues. If there are other issues out there, like I know people have been paying a lot of attention to helium, which is a key component to building semiconductors. If there is additional sort of any kind of issue there in terms of getting supply and so forth, we could see additional pressure on these companies from those kinds of issues, even absent change in the hostilities.
Okay, Ryan, thank you very much for joining us. Have yourself a great weekend. Bloomberg's Ryan Vlastelica, Coming up, we'll get some insight into how the war in Iran is affecting Canada's economy and predictions for the Bank of Canada's next rate decision. That's next. China has launched 2 investigations into U.S. trade practices. Beijing says the probes are to safeguard the interests of Chinese industries and are in response to investigations announced by U.S. President Trump earlier this month. China has expressed a firm opposition to America's investigations, and the move comes ahead of Trump's visit to Beijing in May. Halifax-based real estate company Clark is buying the Ravelin Properties REIT in a deal valued at $1.1 billion. And that includes debt. The transaction is expected to close in the second quarter of this year. The chair of Ravelin's board says the deal is in the best interest of stakeholders as the company continues to face solvency and leverage challenges. Shares of Brown-Forman are getting a boost today. The owner of Jack Daniel's is in talks with French drinks company Pernod Ricard about a potential merger. Both companies are valued at more than $10 billion. The deal would bring together Pernod's top sellers, including Jameson and Absolut, with Brown-Forman's brands like Jack. The talks come as the alcohol industry faces a downturn due to tighter consumer spending. And looking at the markets right now, a little bit of an end of the week rally for the TSX after starting off in the red. It's up above 32,000, up by 0.66% right now. South of the border, though, things are stalled down there. That downward trend continues. Everybody is off. S&P 500 by about 0.56, the Dow by 0.62, the NASDAQ by 0.9. As we mentioned, NASDAQ getting into correction territory now. Okay, it's been a turbulent week for the Canadian economy, with rising oil prices adding new pressure to an already uncertain outlook, even with the Bank of Canada holding rates steady. High energy costs and cooling job pictures are starting to weigh on growth. Let's get perspective now from Pedro Antunes, the chief economist at the Conference Board of Canada. Pedro, thanks very much. Signal 49, I should say, with your name change. Our apologies. We'll get that corrected for you. Pedro, thank you as always for joining us.
Oh, it's a pleasure, Roger. Thanks for having me.
Another interesting week. The oil is continuing to hold, but it's not up. I mean, we've heard doom and gloom of possibly 200 by July, but right now it's below 100. Is that something that the economy can absorb, or is it putting pressure still?
Well, obviously $100 oil is not good news for the economy. Oil price and energy price hikes or shocks always lead to inflation. Not always recession, but always inflation. So this is a concern. I mean, the economy, both in Canada, I think globally, and certainly in Europe, they're going to take another big hit from this energy shock. The big question is, how long does this last? Because we are going to see it right off the bat on the inflation numbers as they come in for March and April. What we don't know yet is how long and how high are oil prices going to stay, and how much will then that affect transportation costs and just more broadly through the economy lead to higher inflation. A lot of uncertainty, and markets are reacting to that unknown, really.
Do we know what inflation might be looking like for March with the fuel? Like even a ballpark at it yet?
Oh, well, it's not hard to figure out because essentially consumers in Canada, about 3% of their basket is gasoline, directly just gasoline. So if you have a 20% rise in gasoline prices, that's 0.6 percentage points on the bottom line. So 2% inflation going to 2.6% inflation when we compare that year over year. And that's a 20% increase in gasoline prices, which is around what we've seen already at the pump these days.
And what happens? Let's take a couple. If it ends, say this weekend, I mean, they've extended Trump has extended to put a 10-day extension on. What happens if we do see what looks like an end, or we're seeing oil get through the Strait of Hormuz? What happens with gas prices here, and do we avoid either a recession or significant inflation?
Well, yes, let's hope we can avoid significant inflation. That is the kind of knock-on effects of higher energy prices through the whole supply chain and transportation structure. Let's not forget that oil is, essentially also a big input into petrochemicals and plastics. I mean, it's just, we need energy and oil for pretty much everything still. So the big question is, can we avoid it? I'd go back to where we were at the start of the year. We were looking at fairly depressed WTI. That's the benchmark in North America. Oil prices were around $58 a barrel to start the year. I don't think we're going to go back to anything like that because we've seen production facilities hit in the Gulf. There's going to be constraints on the ability to get oil to market, even if the strait is reopened. So I do think that, what we've seen from central banks, both in Canada, the Fed and other central banks, very hawkish this time around, because we had this is a bit of a repeat of what we saw in 2022 when Russia invaded Ukraine, and inflation was tenacious back then. And
then we're going to go the other way with a little doom and gloom. This continues, and oil does shoot up 150 a barrel, say. Which I've heard 200, but 150 is another one that's kind of bounced around.
Yeah, I think that this would be a kind of a global recession scenario if we went to those kinds of levels. I mean, I think already Europe, in Europe has been just barely coming out of recession over the last 2 years as they finally got inflation back down, and we were hopeful to see interest rates coming down in the U.S. and in Europe to help kind of stimulate the economy back to normal growth. So already very tentative with this, essentially the trade war that we have that we've been undergoing globally. Imagine now an energy price shock that would almost triple energy prices from what we had assumed prior to this war. Yeah, I think this would be a recession scenario, no doubt.
And what does the Bank of Canada do with all that's unfolding right now?
Well, I think for now, the bank is signaling that they will fight inflation very strongly. I guess they want to avoid, remember that the bank can only control so much around inflation. What they're really targeting is inflation expectations. They don't want folks to start thinking that inflation is going to be running at 2.5, 3, or higher, because then that starts to affect wage settlements. And we've been essentially the central bank has been fighting off, kind of inflationary expectations, and we've finally seen kind of year-over-year wage increases realigning with a 2% inflation target. They have been very strong catching up to that inflation that we had in 22 and 23. So this is what the bank wants to avoid, is a repeat of that. The messaging has been very strong. I don't think we're going to see any more declines in interest rates in this environment. If anything, we may see some uptick in interest rates going forward.
And then with the markets, they've been reacting obviously to what's unfolding in Iran. Are there other factors at play here with the drop-off we've seen? I mean, we've seen the NASDAQ into correction territory. Is there more things at play?
Well, for me, on a kind of a macro perspective, what we're looking at is the implication of higher inflation on short-term interest rates and financial markets now pricing that in. We've seen bond yields picking up. I think there's just concern in general about sovereign debt writ large, and now we tack on, possibly this higher inflation. And of course, as bond yields come up, this has a downward effect on equity markets more broadly.
Okay, we'll wrap it up there, Pedro. Thank you as always for joining, so appreciate it.
It's a pleasure. Sorry about all the bad news.
Oh, it's been all day like that. Pedro, thanks again. Have a great weekend.
Take care.
Pedro Antunes is chief economist at Signal 49 Research. Coming up, new estimates show a U.S. ground deployment in Iran could add $15 to $20 billion U.S. a month to the war's cost. We'll have more on that after the break. A new analysis shows sending U.S. ground troops into Iran could cost an additional $15 to $20 billion U.S. every month, roughly double the peak monthly price tag of the Iraq War. Now, this could create major tailwinds for defense contractors. For more on this, let's bring in Wayne Sanders, senior defense research analyst at Bloomberg Intelligence. And Wayne, thanks very much for joining us.
Thanks so much for having me. I appreciate it.
That is quite the price tag. Where does all that come from? What are the costs in that?
Yeah, when you look at what we're doing already in terms of the carrier strike groups, the amount of overflights that we are using for air superiority campaigns, the targeted strikes against Iranian infrastructure as well. You put all those pieces together, and there's quite a bit that actually goes into those numbers, from the operation and sustainment costs of an aircraft carrier being somewhere between $4 to $6 million a day, and the carrier strike group coming close to $10 million a day. You put those together, you're on a floating aircraft carrier, right? You're a floating air base, and so the amount of fuel and projected munitions deployments that we have already had all starts to add up into this, and that's not even including some of the maintenance and repair operations costs that end up coming in the back end as well.
And is this on top of what just a day-to-day cost of running all these different things and having the soldiers sitting at their barracks back in Fort Bragg or somewhere?
Yeah, when you come to ground troops, it's a little easier because you can price that in and say, okay, you've now had to bring them overseas, and now you have to provide not only the support, the logistics and repair tail for being able to do that. There's a lot of already built-in cost, though, when you're dealing with the Navy. So when you look at the Carrier Strike Group, they already operate regardless of. But we've been doing surge operations, also known as high operational tempo, high op tempo. So at that point in time, you are surging additional capacity into the region. So if that was something that was going to be sustained, it's not nearly going to be as high as the $11 billion that we originally had during the first 6 days because of the amount of surge capacity that was built into that. But we are starting to see now more of a 15 to 20 billion as opposed to something that would look like 40 or 50 if we sustain that surge capacity.
And this feels far more expensive than some of the, per capita, it feels far more expensive than previous wars, even adjusting for inflation, et cetera, et cetera.
Yeah, inflation definitely plays a part of it. So does the exquisite munitions that have been used, as well as the technology advancements that have been made. So a lot of our munition capabilities, seeker technology, a lot of those things play into the increased cost of operation sustainment for these specific areas. Midlife refueling for an aircraft carrier, for example, is an extremely expensive thing. So when you start looking at having to increase their deployments, increase their rotations around the world, it's going to start coming at a cost as well.
Now, I assume the defense sector would be benefiting, but I thought I saw today that it was down about 7% recently, which seems contradictory.
Yeah, so a lot of things when it comes to defense stocks is markets react to headlines, but defense stocks ultimately follow budgets. And so right now, I think we're right in that middle area where people are trying to see whether or not an additional $200 billion spend is going to go through Congress to increase some of the deals that have currently been made between RTX, Northrop, BAE, Honeywell. They have all been given some munitions contracts over the last 72 hours to increase their production and quadruple it. That obviously, though, goes part of it back into CapEx to build out some of their lines. But what you're going to see is the increase in the budget is going to stay up. It's going to stay at this higher level demand. I think you'll see that. You've seen President Trump talk about it. Secretary Hegseth has talked about it. And so that's going to be in the multi-year procurement programs and what they call the acquisition framework. The demand is now 5 to 7 years. And so now you have the ability for the defense primes to actually come back, reinvest into their own lines and be able to ensure that that demand is going to stay. It's not going to fall off as soon as the war ends.
And it's going to stay, it's going to stay busy because they've used up quite a few years worth of stockpiles, have they not?
Yes, sir. They absolutely have. So think RTX and Lockheed for munitions and air defense. Obviously, replenishment makes the news on those all the time, especially when you look at air defense interceptors as well as long-range exquisite munitions. General Dynamic for armor and logistics. If you have a ground force, insertion is going to be one of those areas where they're proving their pudding, if you will, and will continue. Huntington Ingalls for amphibious lift, and then Northrop and L3 Harris for their intelligence, surveillance, and reconnaissance, which has been vital and critical to the last 4 weeks in being able to provide that intelligence back.
Okay, Wayne, thanks very much for that update. We appreciate it.
Anytime.
Wayne Sanders is Senior Defense Research Analyst at Bloomberg Intelligence. Up next, we're with Alan Small, Senior Investment Advisor at the Alan Small Financial Group, IA Private Wealth earlier. We'll see why Meta and Google are on his radar. Earlier, we were joined by Alan Small, Senior Investment Advisor at the Alan Small Financial Group, IA Private Wealth, to see why Meta and Google are on his radar due to their liability in social media addiction.
Obviously, yesterday with Google and Meta, we heard about the ruling, the lawsuits, right? The addictiveness of their platform or their algorithms or whatever you want to call it. And I guess they lost the lawsuit. I think, again, the amount of money that Meta is going to have to pay, I think it was like $3 million or something. It's a drop in the bucket.
It's what it opens up, though, right?
Exactly.
It opens up to more of them.
Exactly. So the question is now every person, family, parents across the United States and anywhere else going to now sue for the same thing? Mm-hmm. Is it going to set precedent for that? And I think that's why both Meta and Google, I believe, are appealing the ruling. And I personally just think it's hard as a parent of 4 myself. I think it's difficult to say that these businesses are at blame or at fault for any negativity that comes from the addictiveness of these platforms.
Well, yeah, but I mean, if they're deliberately directing things and they know they're directing you towards things.
I think they are from a advertising standpoint. You know, businesses pay them a lot of money to have their information sent to those that are interested in, you know, buying ski boots or, you know, buying this or buying that, depending on what you're looking for. They see where you're going online, and then they send you the advertising for it. Very, very convenient, right? But I think that, you know, the kids and you know, and speaking for my kids, of course, you know, we try to monitor, you know, how long they're on their phones, how long they're on their YouTubes and their chats and all that.
Yeah.
And I just think today, you know, we as parents, we try to limit that. And I think if you can do that, it's very difficult, as I'm sure all the parents watching will agree. But I think there is some accountability on the parent side to try and monitor that, speaking from as a parent now. So, yeah, we'll see what happens with the lawsuit. I think, obviously, the appeal, I think it's going to be dragged on for quite a bit. And stocks were down yesterday, but it was a bad tape, right? Meta was down quite a bit, 8%, I think.
Yeah, was it 8% yesterday?
Yeah, something like that, down to the lowest I've seen it in quite some time. Stock, once upon a time at the highs, $796 a share. Today,
8%, holy cow.
Yeah, today much lower. I think trading, 500 and was it 547 to close last night? So to me, yeah, I think it was a combination of perhaps the lawsuit, but also a bad tape. We'll see if the markets can turn around and go positive today, although they're down again, the futures. We'll see where Meta goes today. Will we see a bit of a rebound? So I'm not sure what the longer lasting effects on these companies will be. I think there's a lot more to focus on for these companies in terms of AI and all the other stuff.
Is this just kind of a further reminder, people, that maybe the glow is off the rose? What is it? The bloom is off the rose for the Mag 7. I mean, they've talked about AI. They're spending on AI. People are already worried about that. Is this just another reminder that, like, maybe they're not as good an investment as people thought they were?
Well, I don't know if they're not as good an investment, but I do believe that whole AI hype and the impressiveness of what these companies are doing or have announced, I think that shine is wore off. You know, you look at a name like NVIDIA, the biggest company in the world. They come out and tell you that they have $1 trillion backlog of business just from their two chips, Rubin and their Blackwell chips. Not mentioning what they do, their chips for cars and their gaming and all the other stuff that they do. $1 trillion backlog, up from $500 billion. So they doubled their backlog. The day they announced that at their conference, the stock went down. What is it going to take for a name like NVIDIA to see $200 a share again, or see perhaps a new high above 212? I don't know at this point. So maybe the shine is off these Mag 7 names. The bar is set so high for them. What's it going to take to impress? That is a great question to ask. And why you're seeing a name like NVIDIA trade with a very narrow trading range over the last year.
Yeah, it's been really flat, hasn't it?
Yes.
Absolutely flat. Is it going to take the AI moment? Will that bring everybody back?
Or
will people still be cautious?
I think people are cautious because it's a law of large numbers, victim of your own success, whatever you want to call it. I always use Walmart, right? You know, a name like Walmart, at some point, it can't continue to grow, or any company. You know, you grow 20%, 30%, 35, 40%. Eventually, you go from 40 back to 35, and all of a sudden, investors say, is this as good as it gets? And they start to sell your stock because you've reached peak earnings. And so that's what possibly is happening here for those set of companies, whether it's a Meta, Amazon, Google, NVIDIA, whoever it is. Microsoft is about a year ago as good as it gets. And will these companies, struggle just to maintain that high level? I think that's what investors are asking in general right now.
And that was Alan Small, Senior Investment Advisor at the Alan Small Financial Group, IA Private Wealth. Well, as conflicts in the Middle East continue, the price of diesel has been soaring. This has significantly affected the trucking business, and several companies are noticing higher costs for the transportation of their goods. CTV's John Venavalli Rao has more.
For truckers across the country, as they pump pricey diesel into their trucks, the numbers are numbing to look at.
Diesel prices are going very high. It's like huge difference.
At Toronto-based CSA Transportation, they move all sorts of products from clothes to health supplements from its terminals to cities across the country and into the U.S.
Yep, these are all going to be filled up.
The VP of Operations, Rebecca Herbsch, showed us some of the trailers ready to be loaded. And with the price of diesel surging, she says the trucking companies they partner with have been charging them a lot more.
They want to raise their rates. They want a fuel surcharge. Some of them are charging 40, 50, 60, 70. We even saw 80% fuel surcharge one day.
Herbsch says after holding off, her company raised its freight rates on Monday, though hasn't yet passed on the full costs of rising fuel to customers. Still, she says if the war continues and diesel stays high, consumers will soon see the result when items hit store shelves.
It means that the cost of products is going to go up. The more that vendors have to pay us to move their goods, especially cross-border, the more that we're going to be paying for goods.
And for those truckers who pay their own fuel bills, the soaring price is hitting hard.
The cost to fill up a truck like this that holds about 1,000 liters of diesel has gone up around $700 since the start of the war.
Benit Puri owns 4 trucks and says his fuel costs have gone up around $4,000 a month.
Need to have prices down, man. Just give us a break.
He says his credit cards are getting maxed and wants to see governments cut taxes on diesel.
We're driving trucks. We're providing food. I work for Walmart, right? My company works for Walmart, and we deliver up north, right? So, I mean, we are struggling 24/7. If they can give us some discount on that, some relief on that, that would be great.
With those in the trucking business worried fuel prices will go even higher and warning it will show up in just about everything. John Benavalli-Rouse, CTV News, Toronto.
Market Call is coming up next, and today on the show we have Brianne Gardner, Portfolio Manager and Senior Wealth Manager, Velocity Investment Partners of Raymond James Limited. Her focus, North American large caps. And let's take a quick look at the markets, see how they're doing as we head into the lunch hour, and a little bit of a rally going on the TSX to end in the green. Maybe we'll see what happens. It's up about half a point right now. And on Wall Street, everything pretty much is in the red. Quick peek there. Yeah, not a good day. Correction territory with the NASDAQ. That's it for Morning Markets. Thanks for joining us. Have a great weekend. We'll see you on Monday.